Hey y'all, this is Mindy Strong. This is the section on trading basics. If you're studying for the Series 65, I hope these videos are helping you out. This is not to be used instead of any training program, just to help you guys visualize the abstract concepts. Okay, let's talk about some negotiable securities. These are sold in the primary market, the new issues sold for the first time. All of them are sold OTC, over the counter. And then the secondary market. So negotiable securities, the new issues sold in the primary, everything else is in the secondary. It's the trading of issued securities. So they've been previously issued in the primary market, and now they are trading in the secondary market. And then this one is broken down into the first market, second market, third market, and fourth market. Those are the sub-markets of the secondary markets. Got it? Good. Here we go. Let's look at the first market, which is in the secondary market. This is, these trade on the first floor of the stock exchange. This is where you'll find your New York Stock Exchange 2000 or 2,500 listed companies, the NASDAQ, which is a little less stringent compared to the New York. Some startups are in there. And then you have your electronic communications network and your options trading. In the second market, within the secondary market, you have the over-the-counter trading of stocks that are not listed in the New York Stock Exchange, Amex, or NASDAQ. This was established with the invention of the phone. Most of your corporate, all government, and all muni debt or bonds are traded here in the second market, in the secondary market. The third market is where you have the trading of exchange traded securities. And these are trading off the trading floor via the over-the-counter market makers, FINRA member firms that are making markets in the New York Stock Exchange, listed issues. Okay? Hopefully that makes sense. That is the third market. Fourth market. This is where the big dogs trade, the direct trading of securities between institutions without the use of a broker. Now it is used to broker institutional trades at lower cost. Okay? Let's talk about brokers and dealers. First of all, this is an important distinction here. It's the first time we really talk about the difference. Dealers are said to make markets, also known as they are standing by, ready to make a quote or a trade. They must be ready to buy or sell. Now, another word that I want to define or term is agent. Another term for agent is broker or middleman. These people earn a commission. The dealers make their money on the spread between the bid and the ask. That's the cost. The ask price is the price the dealer is willing to sell it for. That's the ask. They're asking for money. Think of it that way. They are asking for money. And everything we are talking about here is going to be from the dealer's perspective. Dealer's perspective. If you go to a casino, who's in charge at the table? The dealer. So for all of these, the dealer is the center, the way we speak about these. So the ask price is the price the dealer is willing to sell it for. They are asking for your money. The bid price is the price the dealer is willing to buy the security for. Bid, buy, both start with B. The ask, obviously, has to be higher than the bid for the dealer to make a profit. The difference is the dealer's profit margin. The difference is the cost of trading. That's what it's called, the cost of trading. Now let's look at markets. Markets are active markets that have a narrow spread. Why? Because we're looking at a lot of people that are buying and selling. So let's look at designated market makers, also known as specialists. Okay. These are the dealers on the New York Stock Exchange. They don't deal with the public. They're wholesale dealers for retail members. Retail members like Raymond James take orders from customers. They go to the designated market makers, the specialists, to execute. And in these situations, then Raymond James is the broker and earns a commission. Got it? Okay. There is only one designated market maker assigned to each stock on the New York Stock Exchange. And there is a bid-ask quote. That's the buy-sell price the DMM, the designated market maker, is willing to accept. The spread is the amount the DMM will make doing a round turn trade. So buying at the bid and immediately selling at the ask. So if they buy at the bid and sell at the ask, the spread is the amount they make. The DMM acts as the auctioneer and maintains the book of open orders. Okay. So the ask price versus the bid price is the cost of trading. We've already established that. Everything I talk about here, again, is going to be from the perspective of the dealer. So the dealer has an ask price. That's the price at which the dealer sells. They are asking for that money. The customer, the person that is buying, obviously wants the lowest price, right? They want to find the lowest ask price, the lowest selling price. The dealer is asking for money. What's the best price you got? That's the one the customer wants. The bid price, from the perspective of the dealer, is the price at which the dealer buys. The customer, in this case, wants the highest price. How much are you willing to buy this for? Dealer. Okay, logical. Over the counter. So if we are talking about the principal transaction, then think of a pharmacist is a drug dealer. The pharmacist is the drug dealer and they deal over the counter. Got it? Cool. The over the counter is comprised of thinly traded stocks. The volumes are low. The bid-ask spreads are wide because the volumes are low. There's not as much trading. If there's a lot of trading going on, then the bid and ask are going to be close together. And this is done in the second market. Okay, trading practices. One is not good. This is market manipulation. This is trying to deceive investors by controlling the price, and this is absolutely prohibited. Market manipulation, the word manipulation, never a good thing and not a good trading practice. There is then front running, also not a good practice. This is knowing a big move is going to be made and taking advantage of it yourself. This is also prohibited. There is one other trading practice that's common and it's allowed. It's called trading away. A client uses a broker they usually don't use. This is allowed and it's common. Now, let's look at what to expect to be on the order ticket information. If you have a buy order, then a long position has been taken. If you have a sell order, a long position has been taken as long as they own the shares and they will deliver on settlement. A short position is taken if they're borrowing the shares and they're selling, but they also have to deliver upon settlement. So long you own it, short you're borrowing. There is something called a margin account. That is where you buy securities loaned to customers by the brokerage firm. The firm can then lend these securities to others. So if you're selling short, you have to have a margin account. There's something called a limit order. The buy order is filled at that price or better. At that price or better. That's the limit. At that price or better. The stop limit order is to stop a loss from occurring. It becomes the market order to sell. So there's no guarantee. So the limit, that's the absolute limit. That is going to be guaranteed to be filled at that price or better. That's my limit. I've reached my limit, right? But when you say stop, it takes time to stop. So it becomes a market order, but it's not a guarantee. So you claim stop, but it takes time to stop. Okay? The limit order, you've reached your limit. That's it. No ands, if, buts about it. That one is guaranteed. The stop limit order is not guaranteed. Solicited versus unsolicited must be noted. And then timestamps. The order receipt, the order execution, and if it was canceled, the order cancellation. And then a confirmation needs to be set. This is all of the information you could expect to see on order tickets. Okay, let's go more into these limit orders and understand them. So types of trades. First of all, there's a market order. The market order is placed immediately at the current price. Immediately, market order. The limit order specifies the price. This is my limit right here. This. Not a cent above, that's my limit. So the person's going to get that price or better. A buy limit order says, I want this order placed if the price falls to this number or below. So it's set below the current market value. They're willing to buy once it drops to this. The sell limit order is placed above the current price. So if the price rises above a certain amount, they're willing to sell. That's my limit, and it's a guarantee. There's a person called a specialist, and they're the ones who execute the order. I have a couple slides on this right here because this to me is extremely helpful. Oh, slobs. They are over and above the worst. Oh, slobs, right? So O slobs stands for open sell limits and open buy stops. So the orders are above the current market. They are over and above gross. Okay, O slobs. And then there's ob loss. Ob loss is below. So these are open buy limits and open sell stops. These are orders set to be executed below the current market. And I'm going to show you how I personally can remember it. O slobs. They are overly messy. O slobs. And it's over and above the current market. Overly messy. O slobs. And then ob loss is right underneath. Orders below the current market. And it kind of looks like below right here. Below. See? Below. Wow, Mindy. Genius right there. Okay? Hope that helps you. So, O slobs and ob loss. We already talked about this, but I wanted one more method to try to help you. So if you have an open sell limit, first of all, we know that that means the price we are willing to sell at is going to be above. They're overly messy. It's going to be above the current price. They are going to sell if the market rises to this price. So they set the line above and they go up. If it's right here, but if it gets to this line, boom, that's when you sell. And they're guaranteed. I have reached my limit, so that is a guarantee. That's the least willing to accept, okay? Open buy limit. Open buy limit right here. So we know this is going to be set below the current market value. If the market starts to drop and it falls to this, we have reached our limit, and it also guarantees a price. Okay? Now there's an open sell stop. When you tell someone to stop, it takes a second. So if you open sell stop, let's find it. Open sell stop right here. So it's going to be set below. You sell if the market falls to this price. It's the most you're willing to lose. And then your open buy stop is going to be placed above, and you're going to buy if the market rises to this price. It's used to buy before you have to pay more, and it limits a loss. The actual price of this is unknown because it takes a minute to stop, right? It takes a minute to stop, but the limit is the limit. That is guaranteed. You have reached your limit. Okay, hope that helps. Now, there are a couple different types of accounts, two main ones. One is a cash account. This is where it pays in full for securities they buy. You can sell long, aka you own it. Margin account. Deposits a portion of the funds and the balance is loaned to the customer by the firm. Interest is charged on that loan, and you must have collateral. That's going to be all of the securities in the account. You can resell securities if the loan isn't repaid. They can resell the securities. Customers can sell their own securities long, and they can sell securities borrowed short. 50% is usually required to buy versus borrow. So usually 50% of that in the account has to be yours. Equity in these accounts must remain above 25%. Options cannot be purchased in here. The market maker is the dealer for these. And then you have an options account. The customer can sell options. So there are two formulas that you should absolutely put on index cards. One is how to find the long account equity. And that is by taking the long market value and subtracting the debt. And the other is the short account equity. And you find that by taking the credit and subtracting the short market value. Calculating performance in an account. These are all familiar. We've seen these so many times. So how do we calculate how our account has performed? The total return is calculated by taking the annual income plus any annual capital gain divided by the purchase price. Inflation adjusted return, you take the total return and you subtract inflation. If there's deflation, you add that. After tax return, it's the annual income, multiply that by 100 minus the tax bracket, plus any capital gains, which should be multiplied by 100 minus the tax bracket, and divide that by the purchase price. So the only difference here is between the total return and the after-tax return is we need to consider the tax bracket. And then there's the current yield. It's the annual income divided by the market price. Okay, market price, current yield, market price, not purchase price. We're not looking at the return you got based on how much you paid. We're looking at the current yield, the annual income that it will give, and divided by the market price. Okay, and that's it, y'all. That's it. That's trading basics. Hope this has been helpful. Let me know. Watch my other videos. Let me know what you think about those too.